Everyone, for a moment, forget about KDJ, MACD, and every technical indicator you've memorized, and throw those theories that say rate hikes are bearish for gold straight into the trash. Because yesterday, the global financial markets experienced a massive logic coup. Fed Chair Jerome Powell, the man holding the world's monetary faucet, stood in front of the entire world and announced a simple decision: no change, rates stay put. According to decades of Wall Street trading dogma, this should have been gold's darkest hour. High rates mean high opportunity costs for a non-yielding asset like gold. A hawkish Fed should strengthen the dollar. By all logic, gold should have crashed, and bears should have been popping champagne. But what actually happened? Reality slapped every believer of old-school doctrine in the face. Gold didn't fall. It broke free like a wild beast, exploding upward the moment the decision dropped, smashing through the $5,500 ceiling and charging straight toward $5,600, a level never seen in human history. Silver followed right behind, ripping higher to $119. This wasn't just a price move. This was a transfer of pricing power. It revealed something deeply unsettling. The Fed's remote control no longer works. For decades, the Fed could move a finger and control global asset prices by tightening or loosening the dollar. But now, the market is voting with real money, a full-blown vote of no confidence. Top-tier Wall Street capital isn't buying gold to gamble on a 25 BP rate cut. They're not chasing short-term trades, they're running for their lives. They re-abandoning a sinking ship called dollar credit and jumping into the only lifeboat left, gold. A lot of people reacted immediately. Oh, I get it, Iran is about to go to war. So this is just risk-off. If Iran is all you see, you're only looking at the tip of the iceberg. Yes, fleets are moving toward the Persian Gulf. Yes, fingers are hovering over triggers. That definitely poured fuel on the fire. But here's the real question. If this were purely a geopolitical hedge, why didn't the dollar reclaim its throne? Why did the dollar index only manage a weak dead cat bounce instead of a real comeback? Because the underlying logic has undergone a nuclear-level mutation. This is no longer a short-term risk trade. This is a monetary rebellion against dollar hegemony. The market isn't trading CPI anymore. It isn't trading NFP data. It's trading the funeral of dollar credit. People have suddenly realized that the once invincible dollar, that green piece of paper backed by U.S. credibility, is growing thinner and less trustworthy by the day. Runaway fiscal deficits, a Fed that's losing independence, geopolitical fractures everywhere. Gold is shedding its label as a commodity and reclaiming the armor it wore for thousands of years. King of money. At $5,600, gold isn't expensive, the dollar is rotten. So which exact sentence exposed the Fed's weakness? What overlooked detail became the final straw, breaking dollar credibility? Next, we go into dissect Powell's seemingly calm speech and show you the danger hidden underneath. Many people think Powell's speech was boring and uneventful. That's because they missed the subtext. Buried inside those dry bureaucratic phrases was a detail that made smart money suffocate. When asked why inflation, especially core PCE, is still stubbornly above 2%, Powell gave an extremely dangerous explanation. He said inflation is mainly driven by tariffs, causing a one-time price increase that will peak and fade over time. Does that sound familiar? It's the zombie resurrection of transitory inflation from 2021. Back then, they blamed supply chains, and inflation ran straight to 9%, destroying global assets. Today, the scapegoat is tariffs. The subtext is crystal clear. This inflation isn't caused by money printing, it's trade policy. Not my problem. That's full and playing dead. It means the Fed has quietly accepted higher inflation tolerance to accommodate fiscal expansion and keep the U.S. debt Ponzi alive. Fighting inflation, that's just a slogan on paper. Maintaining fake prosperity is the real KPI now. Look at his stance on future policy. Meeting by meeting, no preset path. Data dependent. Sounds responsible. In reality, it's pure verbal tai chi. A Fed chair nearing retirement, and possibly political reckoning, has only one survival strategy: Don T. Rock the boat. He won't be the villain who bursts the bubble, and he won't dare anger Wall Street. That ambiguity exposes the Fed's weakness completely. The market wanted a Volcker-style hardliner. Instead, it got a puppet kidnapped by deficits and neutered by politics. When a central bank loses independence and starts making excuses for inflation, its currency's credibility anchor snaps. That is the core driver of gold's surge. Global central banks aren't stupid. Wall Street isn't stupid. Look at the data. Central banks are aggressively buying gold while quietly dumping treasuries. Why? Because the future script is obvious. Uncontrolled deficits gives forced monetization, gives inflation spiral, gives dollar purchasing power collapse. Holding dollars in that script is slow suicide. Gold's rally is global capital repricing the collapse of dollar hegemony. They want an asset with no counterparty risk, no sovereign dependency. Gold is the only answer. Stop staring at the Fed's dot plot. That's kindergarten stuff. Real players are going long gold to short the entire dollar system. If dollar decline is the slow variable, then the storm clouds over the Persian Gulf are the fast one. My answer is simple, yes, but it's a side plot. It's an accelerator, not the whole story. Gold didn't push toward $5,600 because of missiles. It got there because global central banks laid the foundation with their distrust of the dollar. But if gold is going to rip from $5,600 straight to $6,000 or higher, it needs a shot of adrenaline. Now look at the headlines. Trump warns that a massive U.S. fleet is rapidly moving toward Iran, larger than the one previously deployed to Venezuela. Iran's foreign minister responds that their fingers are already on the trigger. With 200% defensive readiness, both sides have backed themselves into a corner. There's no room left to maneuver. So what does this mean for gold? It means every short seller is terrified. When dollar credibility has already pushed gold to record highs, and you then layer on nuclear-level war risk, all upside resistance gets wiped out. It's like pouring gasoline on a pile of firewood that's already burning red hot. The market's logic right now is brutally simple. Whether war actually happens or not, buy gold first. Ask questions later. But now, let me pour a bucket of cold water on you, because this is the chief risk warning you must understand. The main storyline, dollar weakness, is long-term. You can think in years, even a decade, but the war storyline is short-term. It might only last days or weeks. Right now, the market has priced in war expectations very aggressively. That 80 to 90% chance of conflict is already embedded in today's $5,600 price. And financial markets follow one iron law: buy the rumor, sell the fact. Here's the trap. If actual fighting breaks out or if the situation suddenly cools down through negotiations, the part of gold's rally driven purely by panic could unwind fast. History proves this again and again. The moment the first shot is fired is often the short-term top for gold. So don't chase prices just because of Iran. Treat Iran as a magnifier, not the trigger. What ultimately decides gold's fate is still the slowly bleeding dollar giant. Now, in this complex market where main and side narratives overlap, is gold the only asset flashing signals? Why is silver also going crazy? Is the dollar index rebound real or fake? Next, we shift to a market resonance perspective to expose the illusion behind the dollar's rebound. If gold is the leader of this monetary rebellion, then silver is the wild shock trooper charging at the front. Look at silver's move. It surged straight to $119, a historic high. 2 weeks ago, this would have sounded insane. Remember, silver had a massive headwind. The CME had just raised margin requirements. Under normal logic, higher margins should cool speculation and crush prices. But what happened? Silver barely bowed its head, then snapped back violently, following gold's lead. What does that tell you? It tells you the trend is irreversible. When fear of dollar collapse combines with geopolitical war expectations and hits critical mass, all technical suppression methods fail. Margin hikes stop working. Rules stop working. Capital logic becomes extremely primitive. If gold dares to break $5,600, silver dares to test $120. This isn't just risk aversion. It's a violent repair of the gold-silver ratio and a brutal mockery of the fiat system. Now let's talk about the most misleading indicator of all, the US dollar index. After Powell held rates steady, the dollar index did bounce back toward 96.3. A lot of people hesitated. See no rate cuts. The dollar is still strong. Shouldn't we exit gold? Don't fall for it. This was a textbook dead cat bounce. The rebound was propped up mostly by verbal intervention. Treasury Secretary Bessent saying he prefers a strong dollar. But structurally, the dollar's spine is already broken. Think about this paradox. Why are U.S. stocks rising, Treasury yields moving, gold exploding, and even the dollar index bouncing, all at the same time? In a healthy financial system, these assets should cancel each other out. Gold up gives dollar down. Yields up gives stocks down. So why is everything going up? There's only one answer. The denominator, the dollar itself, is depreciating. When deficits spiral out of control, when the Fed ignores inflation, when geopolitics threaten the petrodollar foundation, everything priced in dollars rises, not because assets are more valuable, but because money is worth less. That's the loss of credibility we talked about earlier. This dollar rebound is just the Titanic tilting upward, right before it snaps in half. So don't let short-term dollar moves scare you out. In a drama scripted around credit collapse, gold and silver are the only unsinkable arc. Which brings us to the final question. In this chaotic transition between old and new orders, what should an ordinary investor actually do? Go all in now, or wait for pullbacks? This is the final chapter, and I'm about to give you the chief instructions. This may be your only ticket to the next world. At this point, the grand drama of gold, the dollar, and war has been fully dissected. The conclusion is clear and deeply subversive. $5,600 is absolutely not the top. It's just a milestone marking the collapse of the old order and the birth of the new one. If you're still using old valuation models to calculate a fair price for gold, you're carving a boat while chasing the sword. You must understand this. When the Fed starts making excuses for inflation and blaming tariffs, when global central banks accelerate de-dollarization, we are witnessing a restoration of monetary kingship in human history. In this moment of old systems collapsing and new ones not yet established, I'll leave you with 3 survival and defense directives. First, use war pullbacks to accumulate. Remember the warning about good news being fully priced in. If the US and Iran actually clash, or if tensions suddenly ease through mediation, short-term war gamblers will rush for the exits. Gold could see a sharp drop, but that won't be the start of a bear market. That will be the reverse pickup opportunity. In this long de-dollarization cycle, every pullback caused by fading geopolitical fear is a window to exchange depreciating paper for hard money. Strategic long positioning is the theme of the next 5 years. Second, lock your eyes on the $6,000 qualitative threshold. Yes, short-term pullbacks are possible, but upside space remains wide open. If geopolitics stand cool or spiral out of control, current market pricing is nowhere near enough. Once gold clears resistance above $5,600, it enters a self-reinforcing acceleration phase, aiming straight for $6,000. Don't jump off the train unless the Fed suddenly turns into Volcker, or US deficits miraculously disappear. Third, block out the Fed's noise. Stop obsessing over Powell's 25 basis point games. That's tactical distraction. What you need to watch is the fracture in dollar credibility. As long as the Fed cooperates with fiscal expansion, as long as inflation is buried under verbal tai chi, your stance should remain firm. Stand with gold. In a crazy era like this, only those who understand the true nature of money can protect their wealth. Hold your gold tightly. It's not just metal, it's your ticket to the next world. Don't let the illusion of paper money blind you.